So, what is stock market sentiment, and how does it impact stock prices? That's the essence of this video: stock market sentiments, and what it is and how it impacts stock prices. Stock market sentiment refers to the overall mood or attitudes, of investors towards the stock market or a particular stock. You have market specific sentiments and even stock specific, company specific sentiments. So it reflects how investors feel about the markets or individual stocks, which can be influenced by various factors such as economic data, corporate earnings, geopolitical events, or market trends. Sentiments can be broadly categorized into positive sentiments, bullish, or negative sentiments, bearish or neutral. And it's often drives market behavior in the short term. Thank God it's just in the short term. Sentiments has its impact in the short term, but in the long run, fundamentals are what really actually drives and stock prices. So let's see how stock market sentiments affect stock prices. Number one is investor behavior. Sentiments impact investor behavior. So in this case, positive sentiments, that's a bullish outlook, encouraging investors to buy stocks, pushing stock prices higher. The more people buy, the more the price goes up. Conversely, negative sentiment, that's bearish outlook, leads to selling, which causes stock prices to fall. When you have more of selling than buying, the price will go down. You have more of buying than selling, the price will go up. For example, during periods of optimism, investors may take on more risk, driving up stock prices. The more risky investors become, the more they will drive up stock prices. So in contrast, during the time of pessimism or fear, investors may sell off their holdings, contributing to price decline when there's an oversold condition in the market, and the price will certainly go down. Number two is a market momentum. Stock prices can move in the direction of prevailing sentiment due to hard behavior. Hard behavior is very, very powerful. It may not be right, but it's powerful. It's a powerful kind of factor one should consider as an investor. When many investors share the same sentiment, either positive or negative, it creates a momentum effect. In the case of positive sentiments, it will drive stock prices up. In the case of negative sentiment, it will drag prices down, regardless of the underlying fundamentals of the company's concern. All right. So that's the way it is. Number three is impact of news and events. Impact of news and events on stock market sentiments. So news events, or economic reports significantly influence market sentiments. Positive news, such as strong earning reports, government stimulus, or favorable economic data can lead to a rise in sentiment and consequently stock prices, because these factors will influence sentiment, and sentiments will end up influencing the overall stock price. So that is the way it is. Positive sentiment has its own effect, and negative sentiment equally have its own effect. When sentiment goes negative, stock prices drop. When sentiment goes positive, stock prices will tend to climb. Please like this video and subscribe to this channel if you've not done that. So you can keep me encouraged. kind of. Number 4 is psychological factors. Psychological factors. It's so interesting to note that these factors affect the market. Apart from the result, the core company fundamentals, all these factors around, they tend to influence the market in the short run. And we need to be conversant with them. So number 4 is psychological factors. Psychological factors. Sentiment is often driven by psychological factors, including fear, including greed and optimism, and even pessimism. For instance, during market rallies, investors may become overly optimistic, bidding up prices beyond their fundamentals. And by so doing, they end up creating a bubble. So during downturn, panic and fear may lead to excessive selling, often exacerbating market decline. These emotions can amplify stock price fluctuations. Fluctuations are always there. It is an inherent part of the market. When it is coupled with extreme sentiments, then you have higher highs and lower lows, which is not a good thing. When sentiment sets in, the result is not always good. Number 5 is speculation and short-term movements. Speculation and short-term movements. So in the short term, stock prices may be more influenced by sentiments than by the underlying company fundamentals. In the short run, these stock prices could be influenced by sentiments. So investors may act on rumors, social media trends, or speculative forecasts, causing sharp prices movement, causing sharp price movements by sentiments rather than actual performance. So sentiments could cause the price of stocks to move sharp, to go on an upward trend. Number 6, sentiment indicators. Sentiment indicators. So investors often track sentiment indicators such as consumer confidence index, such as VIX, and other all these sentiments are things you need to really take into consideration. And usually you may need to survey what consumer feelings are. So you take into consideration consumer confidence index. And you also take into consideration VIX, the volatility index or the fear factor. And so this is done to be able to gauge the mood of the markets. So these indicators can provide insights into whether market sentiments, sentiment is overly optimistic or pessimistic, helping investors adjust their strategy. So depending on the outcome of this analysis, you could adjust your strategy accordingly. So in conclusion, stock market sentiment plays a crucial role in influencing stock prices, often driving short-term fluctuations. While it can be driven by fundamental factors, sentiment is also influenced by psychological and emotional factors. So psychology it comes in, emotions also come in to influence sentiments. And this leads to price swings that may not always align with companies' actual performance. That is my problem with sentiments. They create short-term volatility, short-term actions that are not all that aligned with companies' fundamentals. So that goes along with to show that the efficient market theory is not fully correct. It might be 50% correct because Apart from fundamentals, emotions come to play when it comes to investing.